Hey everybody, Jared Duckett, Duckett Ladd, ZPAs and Advisors, back with Bill Ladd. And Bill, it has been a while on the PPP. We've chatted a lot internally, but haven't put anything out on it. And not that we haven't talked about it, right? We talked about, we actually started working up a case study.
Yeah.
That we were going to go over the forgiveness loan application, that extremely scary 11-page document. We're going to try to walk somebody through that the best we could, but decided to hang tight on that and waiting for this new guidance to come out. So where we're at, guys, it's basically June 4th, and it's the bill that the PPP Flexibility Act of 2020 has been passed by the Senate. It was passed by the House last week, passed by the Senate this week. I'm still waiting on to see if President Trump has signed it yet. Bill, have you seen anything on that? I think we're still waiting.
No, he's still waiting.
Yeah, so we're still waiting on that, but everything, we're anticipating him to do it. So what we want to do today is just really hit the high points. What has changed, what has been updated with this Flexibility Act. So we're going right down to the actual document, and we're going to scan through here. And again, we're going to stay pretty high level here, but we want to give you guys the big points that came out of it. And just scanning through the first thing, and what this act does, I guess I should say it, this is not really a standalone act. This act basically amends certain paragraphs, if you will, of the CARES Act. It's not a standalone act, so it amends a lot of dates, it amends a lot of, strikes through and amends a lot of paragraphs, and also adds a couple paragraphs to it. So it's not a standalone act. But just
so by that nature, it's
kind
of hard to read. I mean, you can't really read this like you could the CARES Act and make sense. I mean, you have to do a lot of cross-referencing back and forth to the source document. And once you do that, it starts to come together.
Yeah, you're exactly right. So it's almost like you have to have the CARES Act up on one screen and search, and feel like we're kind of lawyers, searching through these legal documents a little bit. But I guess the first thing that they hit us with here is basically, originally in the CARES Act is the PPP loan. The amount that wasn't forgiven, is an actual loan, and it basically has a 2-year maturity date.
Yeah.
1% interest, 2-year maturity date. And they've changed that, changing the 2 years to a 5-year maturity date. Same interest rate, right, Bill? But just
same
5
interest
years.
rate. Yeah.
Okay.
Yeah. So just another way to try to help people with cash flow. The 1% did stay, which was huge, but obviously amortizing that over 5 years versus 2, that's a big difference. So for some people, who maybe carry a larger loan after forgiveness, that could be a big deal.
Yeah. Yeah, you're exactly right. And this is really the biggest part of it is the covered period. And this is where the Flexibility Act is really helping businesses, in my opinion, is, people were getting squeezed on this June 30th date, especially businesses that waited to take the PPP funds maybe till May, and maybe they still weren't open. A lot of dental offices still weren't open, and how in the world are they going to spend all this money by June 30th of 2020, this covered period? So the big thing in this Flexibility Act is they went back and amended it, and instead of that June 30th, 2020 date, they basically put this December 31st, 2020 date in it. So really the covered period is I guess it should be the earlier of 24 weeks after your date of origination, or December 31st, 2020. So I kind of started going off on a tangent a little bit, but the 8 weeks turns into 24 weeks.
Yeah.
And then they threw the December 31st, 2020. So this is huge for businesses, in my opinion, Bill.
Yeah, there's no doubt. I mean, that gives you a lot more time. I mean, it was kind of coming down to where people had to make staffing and payroll type decisions in a week's time period, or look at trying to figure out how to get to those numbers. And some people, it just didn't make sense from a business perspective. Now, of course, we all wish we had a time machine to go back and get this data, back at the beginning. This would have been nice to know, and people could have made more informed decisions, but we were kind of, we play the hand we were dealt, and a lot of people were sweating this and saying, I don't have enough time to get this done, or some industries outside the dentistry, maybe they didn't have an overhead model that would allow for 75% of it to be used for payroll, which we'll kind of get into here in a minute. So, extending that time just gives a lot more flexibility for people to incur those costs, pay them. And I think the goal of this legitimately is to try to get more of this forgiven, give people opportunity to have more of it forgiven.
Yeah, I mean, hence the name flexibility. I mean, you
Sure.
just hit on it. This is trying to allow flexibility for the business owner. So again, that 8-week period goes to a 24-week period. You still do have the option to keep the original 8-week period. I'm trying to think
That's right.
through why you would, but you still have that option if you want to keep the 8-week period.
And it
But
could be
this,
if you're good. I mean, if you've done your planning and
yeah,
you hit your numbers, then why complicate it? Why drag this thing out? You can, hit the 8-week period. But for most people, this is going to be a welcome relief to try to get some more cost incurred and try to use that money from the PPP to pay those costs and get it forgiven. So certainly, I think most people will avail themselves of taking advantage of this extended covered period.
yeah. No, you're exactly right. And so a lot of questions then goes to the FTE. They had the FTE safe harbor. If you were able to get your full-time equivalents back to where it was by June 30th of 2020, that was that safe harbor.
Yeah.
That said you were okay. They've changed that date as well. So that date, June 30th, 2020, has been pushed back to December 31st, 2020. For that FTE, and also, Bill, I think, and again, I'm kind of asking a question at the same time. I think it moves that salary and wage reduction as well to push that safe harbor date back to December 31st.
Yeah, by our reading, it takes care of both the FTE and the wages. We've heard other people that take a contrary position. So probably a good FAQ that will come out. Keep in mind that Congress passes this, the president signs it, Treasury implements it, and they come up with an SBA, and they come up with FAQs, and there's a running tally that you guys can go out and see. There'll be a lot of FAQs that will clarify this, but our understanding is it looks to us like it's going to extend the period for both the FTE forgiveness component as well as getting the salaries and wages for an employee back to where it was pre-COVID-19.
Yeah, exactly. And then going right in line with that regarding FTEs, they actually added these paragraphs. These are new paragraphs that wasn't in the CARES Act. And this paragraph here on number 7 is talking about basically rehiring, those individuals. And it puts some more safe harbors in here for the FTE calculation. And basically it says if in good faith the business owner, and again, is able to document, but that you were going out and rehiring those individuals and you couldn't, maybe they didn't want to come back or etc. Or also you went out and tried to replace them because they didn't come back with similarly qualified employees and you couldn't. And also if you weren't able to basically bring your employees back because you had an inability to do so because you couldn't get back to the same level of business activity, and it's using this 215 or 20 date because, of certain regulations that were in place,
Yeah.
Restrictions on operating, especially dental offices, that's another safe harbor that's in play. And again, good faith, document that. But if you don't get it back up to December 31st, 2020, those levels, and you can use this, that's the other safe harbor. So I said a lot there, and there's a lot of language here, but that's an interesting one they've kind of threw in. And I think it's a good move, in my opinion.
Oh, for sure. I mean, they had already taken a pretty rigid standard and added a very favorable component previously, which was that if you tried to bring somebody back, made a legitimate good faith offer, and they decided not to, or you terminated someone for cause, that was all hashed out and was a safe harbor, so to speak. And now they've come in and added these 2 additional ones that if you can't find anybody, now the mechanics are going to be really interesting. How they going to determine that? That's going to be something that we'll have to figure out. Is it if you place an ad? I mean, how do you demonstrate you've legitimately tried to find them? We don't know. It'll be interesting to see, but that is a big deal because some people are just going to struggle finding good people, especially if they're in a certain part of the country where maybe the hygienists aren't growing on trees, right? You have to
Yeah.
search high and low for them. And then, if you are at a spot where you cannot produce at the level you were before, think of New York that just opened up at the beginning of this month in
Yeah.
June. I mean, it's going to be really hard. So, I mean, if your results are such that you can't get back to where you were, do you put a burden on your long-term viability by hiring people? This gives you an option to really look at that. But again, devils are always in the details, and we need to know the mechanics to figure out what does that mean. But on its surface, both of these appear to be a continuation of a really favorable provision that Congress has enacted.
Yeah. Yeah. That's a big one there. Again, a lot of documentation, and good faith there. So another, and this is probably one of the biggest ones in here as well, as opposed to you got the 8-week period going to 24, but they put the language in here, and it's interesting because if you go back and look at the CARES Act, there is nothing really in the CARES Act that spells out that 75%,
No.
25%. That came out, I believe, in the interim final rule, the first one, and that's where it kind of caught us off guard, where you saw that language in there that came out from Treasury and SBA, and we're kind of like, well, where'd that come from? So now it's an added paragraph to the CARES Act, but instead of 75% that you have to spend on payroll, 75% or more, they've changed that. And the language here, I'm going to read it like it says. It says, to receive loan forgiveness under this section, an eligible recipient shall use at least 60% of the covered loan amount for payroll costs, and may use up to 40% of such amount for any payment of interest, and you got rent, utilities, and that stuff. So I'm going to go back again to the first sentence. To receive loan forgiveness under this section, an eligible recipient shall use at least 60%. So if you're watching this video, you might have heard of this, what people are calling the 60% cliff. I'll be honest, I'm not exactly sure if it's a cliff or not. Some people are saying it is. Some people are saying if you don't spend 60% or more on payroll, none of your loan is forgiven.
Yeah.
And I can see that interpretation, Bill. I mean, that's kind of how it reads, to receive loan forgiveness under this section. And so I'll throw it to you. Any comments on that?
Well, yeah, a couple. I mean, read it the way you just said, is to receive loan forgiveness, an eligible recipient shall use at least. I mean, shall is important because down the road they say may use up to 40%. So there feels like a distinction there, right? So when you look at that, keep in mind it was 75%. So now they've given you 15 points and said you don't have to spend 75%, and we're going to give you a longer time to do it. However, you shall use at least 60%, or you may not have forgiveness. Now, again, I agree with you. I think we do need clarification. I will say that I actually had heard Senator Rubio had actually come on, and one of his qualms with this is he wanted everybody to understand that Treasury intends to interpret this as a cliff.
Yeah.
And Treasury is designed to interpret the rules that Congress gives them. And if that's a congressman, a senator saying that they're going to interpret like this, then they're probably not going to do any kind of technical correction if they do. So, guys, I don't know. I hope it's not. That's, something that it's certainly, at least you have some time to plan for it. But that's a huge deal. If it's a cliff, then it's even more important to be looking at this stuff, plotting it out, getting your staffing in line, and it'll be important to hit that 60%. So stay tuned, but plan for the worst is what I would say.
Yeah. No, it's great advice. Plan for the worst. And they, like we said, doesn't just change the number from 75% to 60, because the 75% or more, it wasn't an all or nothing. It wasn't this cliff. If you spent 60%, or use another number, 65% on payroll, in that forgiveness calculation, we haven't gone over that yet, but it had that in there where it was the lesser of a couple items. But how people are interpreting this and kind of how it reads is, my advice is I would interpret it as a cliff. But I'll even go one more step further. Now that they've extended this covered period for 24 weeks out, I'm going to say that you should be able to spend it on the payroll. Now, there might be some circumstances where you can't. Maybe you're just shut down for a long time, I guess. But I would think you could get, 60% of the loan to be used
Well,
on payroll for that time period.
yeah, think back, Jared, how your loan was calculated in the first place.
Right.
It was based upon average payroll times 2.5, right? So, you know, if your operations weren't stabilized, 8 weeks for some people is going to be really tough. 24 weeks, I agree with you for the most part, unless you're uh, you're not receiving any revenue or income, then you should probably be able to hit that 60%. However, again, you have the option to the 8 weeks, but that probably brings into question why you would use that. Unless it's a slam dunk. I mean, you certainly want to give yourself enough leeway to probably hit that 60% with some room. So if any of the cost ever got questioned or thrown out, you still have plenty of excess cost in there to justify the 60%, because a cliff is a big deal
Yeah.
if it truly is a cliff.
Yeah. You're exactly right. I think there's one more down here. So this is basically saying it's in the original CARES Act. It basically says that if you got the PPP loan, that you couldn't delay payment of your payroll taxes. So they allowed you, I forget what piece of legislation that was, Bill, but they allowed you to defer payment of your payroll taxes for 2020, and basically you would pay half, I think, by 12/31/21, and then the other half by 12/31/22. So they gave you that ability, but if you got the PPP loan in the CARES Act, it says you couldn't do that. Now they went back and struck that. And so now how it is with the Flexibility Act in play is businesses are allowed, if you got the PPP loan, to also delay payment of those payroll taxes, which is originally prohibited. Does that make sense?
Yeah, I think it's basically affording you the same benefit that they allow PPP recipients that have obtained forgiveness. What we always say there, though, is be very cautious on that. Anytime you defer payroll taxes, keep in mind they're not forgiving it. I mean, it's
Yeah.
not going away. And in our experience, anytime that you get behind with your payroll taxes, the IRS, they have a tendency to kind of look for that. So, we're advising our clients that I don't know that that's necessarily a default position to take, but again, if it's survival and that's going to help you, keep your cash, then it may be something you might consider. And now they've at least given you the option if you have the PPP and got the forgiveness. So just another flexibility item, small thing compared to some of the other ones, in my opinion, but it's something that some people may find helpful.
Yeah. Keynote, we don't recommend delaying those payroll taxes. Let's
No.
not, they're not forgiven. They're not going to let you not pay them. You're just postponing the inevitable. So we recommend paying and not get behind. One other thing I wanted to add in here, I didn't have it highlighted there, but Bill, I've been getting some questions from clients, and before they were talking about this $100,000 max, of the max deal, and it was how much could be included in that covered period, of the 100,000. So you had the 100,000, and then it was divided by 52 weeks times 8 to get to that 15,385 number. Does that make sense?
Yeah.
So if somebody made $150,000, you could only include 15,385 in that 8-week covered period. And a lot of people are just assuming, well, it's 24 weeks now for this covered period. So now my 100,000 divided by 52 times 24, that's not the case. You can't increase it. It's still that max. So even though your covered period could get extended, to 24 weeks, you can't pay that individual more per person. It's still $15,385 per employee. That's $100,000 or more. Did I make sense there?
Yeah, I think so. Again, everything is, the devils are in the details, and it's really, these things are going to have to be interpreted, and those kind of things are going to have to be clarified, because people are going to ask that question.
Yeah.
And it is a legitimate question, and it's something that until we get authoritative guidance, again, you just kind of plan for the worst and hope for the best. Those are the kind of things that will populate as things come along, and they should. We need to get that guidance sooner rather than later. Or those questions won't go away until they're answered. And at least now we have some more runway to know the rules. I mean, we're not looking at these covered periods ending this week or next week when they were scheduled to. I mean, we've got some time to get some good guidance and make some good decisions. So hopefully those kind of things are going to be answered shortly.
Yeah, you're right. FAQ, and there might be an FAQ that contradicts what I just said. So, it's yeah, those are the rules as we know them now. Again, every other act or interim rule comes out, we have more questions, but we're getting closer and closer. Bill, I'll go back on future videos. I think we had a bet, an over/under on FAQs, and I think it might have been 75. I think you took the under.
Right.
I think you're winning right now. I haven't seen the. I think we might still be in the high 40s. I don't think we hit 50s yet, but
well, just wait.
Flexibility Act increases that FAQs. I might have a chance of winning here.
That's true. That is absolutely true. We'll see. We'll keep a tally.
But guys, we just want to hit the highlights of that. If you have questions, let us know. But that's the PPP Flexibility Act. Hope you guys enjoyed that, and we will talk soon. We'll see you.